our channel. So today we are also starting on a new series which is going to be focused on private equity. This is the first video that we are going to do in the private equity series. And within this video, let's start with the absolutely latest news, what is happening within the private equity space. Let me share my screen. I wanted to share a Financial Times article with you. I hope you can see my screen. Let me flip that. So, what the article is reporting is the private equity management fees is fallen to the lowest level since 2005. And this was a research which was done by industry specialist Preqin. And they are saying that the average management fee for the buyout funds that were closed this year or were still raising money, it has fallen down to the lowest levels, and the average was 1.74 and the previous low was 1.85. What has happened in the past 2 years is that private equity firms have struggled to sell out their investments. What they usually do is that their usual exit routes are initial public offerings or industrial deal making in terms of selling to a strategic investor, but those have been limited by higher interest rates and by disagreements in terms of valuations and general economic uncertainty. And that is why these firms have returned less money to their investors, and as a return, they are leaving these investors with less cash to reinvest in the new buyout funds that these firms are launching. And because of this, there is a downward pressure in terms of fees, because those are the concessions that these funds are having to make to their limited partners. There is a graph that the Financial Times article has shared, wherein it says that in 2004 the average mean was somewhere around 1.89, and in 2024 the average mean is somewhere around 1.74. It also says that it's basically either the smallest funds or the largest funds which are making these concessions. The smallest funds because they are smaller in terms, and the largest funds because they can make those concessions. So the smallest fund, which is less than 250 million, they are charging approximately 1.81, and the largest ones are charging 1.82. But for the medium funds, which is from 250 to 9 to approximately 999 million, or which are in terms between 1 to 3 billion, so they are charging approximately 1.95 and 1.9, which is 2%, which is usually the average that the private equity funds charge in terms of management fee. And it is also saying that over the past 20 years it has hovered somewhere around 19.5 in terms of the percentage of funds, and then the minimum return for the partners is met approximately at 19.5. And the article closes by saying that there is an upsurge of investor interest in private debt, and the private debt also, the management fees is hovering somewhere between this, and it is usually between the first 3 to 5 years that the managers are actively investing the capital. But that is what we know about. I don't know why they are kind of referring specifically to that particular thing. So this is what I really wanted to share with you in terms of private equity. This is a new series that we are going to be starting upon, and within private equity, we will also doing a major focus on the luxury industry as a sector, because within the luxury industry you have a couple of firms which do very active deals. For example, Al Catterton, which is the private equity arm of LVMH, is very active in these terms. Similarly, there are other firms also, and we'll do a deep dive into that. We'll focus on those firms also and the deals that are being done by those firms also. We will also start a series on venture capital, but within venture capital, we are going to focus more in terms of the beauty and the beauty sector, wherein the venture capital is most active when we are talking about luxury and beauty and wellness as a whole. So I hope you've enjoyed this first video that we have done on private equity, and hope you do stay tuned in for more. Thank you.